Our top story tonight, the Fed, the future, and your money. Federal Reserve Chief Ben Bernanke testified on Capitol Hill today, and investors spent the entire day trying to figure out exactly what his statements mean for the future of interest rates, the central bank's bond purchase program, and stock and bond prices. Couple Bernanke's testimony with the release of the minutes from the Fed's last policy-setting meeting, and you have the recipe for a wild day on Wall Street. And that is precisely what happened. The Dow and the S&P 500 zoomed to record highs in the morning. At one point, the Dow was up 150. Then, after the release of those Fed minutes at 2 p.m., it hit session lows off more than 100 points on speculation the Fed could cut back on its bond buying as soon as next month. At the end of the day, the Dow lost 80 in its biggest point reversal from high to close since 2008. The S&P 500 fell 14 and the Nasdaq dipped nearly 39. Two reports tonight looking at Bernanke's testimony and the markets. We begin with Steve Liesman.
It was a day of confusing comments from the nation's central bank, and investors ultimately concluded the Fed will be providing less help for the economy than it previously thought. The day began with commentary from Federal Reserve Chairman Ben Bernanke. The market rallied when he suggested the Fed would not change policy.
The best way to achieve higher returns in the medium term and beyond is for the Federal Reserve, consistent with its congressional mandate, to provide policy accommodation as needed to foster maximum employment and price stability.
But later in his congressional testimony, Bernanke responded to a question by saying, well, on second thought, the Fed could change policy pretty soon.
If we see continued improvement and we have confidence that that is going to be sustained, then we could, in the next few meetings, we could take a step down in our pace of purchases.
If that wasn't enough, later in the day, the Fed released the minutes of its May meeting, saying a lot of its rate-setting committee members believe the Fed should reduce the amount of bonds being bought as soon as June, even though there is no agreement on whether that should happen. Ultimately, the consensus seemed to be that the Fed is going to take its foot off the accelerator of the economy sooner than markets believed, as long as enough jobs are being produced. For more on how the market reacted, here's Bob Pisani.
There's an old floor saying that goes, don't play on days when the Fed speaks. That was certainly true today as traders were treated to a head-spinning session, with traders chasing both sides of the Fed debate. Stocks were up 150 points shortly after Bernanke began his testimony, as he said that any change in the flow of bond purchases will depend on the incoming data, and that ending stimulus too soon would be a mistake. But stocks came off their highs as the testimony switched to the Q&A. Bernanke said the Fed might considering tapering bond purchases in the next few meetings if the data supports an improving jobs picture. That was echoed midday as the Fed minutes from the May meeting came out, indicating some participants favored tapering purchases of bonds if the economic data showed sufficient strong and sustained growth. Stocks moved down on that news, as did bonds, on concerns over higher rates. Interest rate sensitive stocks were especially weak. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.